This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to Bazaar Morning Call. You're watching us live from the CNBC-TV18 Motilal Oswal studio. I'm Sonia Shenoy, and as always joining me is Nigel D'Souza as well as Surbhi Upadhyay. Guys, interesting day, interesting last 24 hours actually. Some amount of volatility has kicked into the market. Little bit of caution as well. So it's been a slightly weak start to 2024. But let's see how it goes. We have big gains under our belt as well.
Well, that's right. Volatile start. On a day-to-day basis, you're seeing the intraday 50-60 point downtake and then the pullback as well. So let's see how this goes. Wednesday, middle of the week. I don't know whether the bulls want to come back and fight today.
Global markets
have they come back from holidays? I don't know.
I think
maybe that's the problem.
I think they're getting back, and global markets have woken up with a hangover. So we have that to deal with as well. At least we preempted the fall, but I think across the board, the start to the new year has been, oh, okay, wow, now we have to get back to work. Yeah. That's the feeling when you're looking at all the red screens around, and we'll talk about that. But let's see. I mean, the good thing is that the buyers are still coming in, so dips are getting bought, and I think that's what we've seen in the last 48 hours.
When Surbhi said, "Ooh, we had to get back to work," I think it was a personal one.
Well, markets at times reflect your mood, right?
So. They do, and aren't we all, right? I mean, the first week of the new year tends to get a little tiring for everyone after all the festivities. But be that as it may, we have lots of cues to track this morning, so let's get straight down to it. There is a lot of volatility in the market, and you can see it both in our markets as well as across the globe. Last evening, in fact, the US markets ended very, very mixed. The worst of the lot was the Nasdaq, which was down 245 points overnight. Otherwise, the rest of the markets were just about okay. For our own markets, the Nifty consolidated, but there was a negative bias in trade yesterday. The good part is, towards late trade, the dips got bought, and we recovered from, the lows of trade, especially in pockets like Pharma, etc. The dips are getting bought, so that is a good thing. FIs bought about 1,600 crores in the cash market, so that money comes in. But there was large selling from DIIs, almost 2,000 crores. So just a little bit of caution entering the system now. Let's see how it plays out. Apart from that, if you look at it, rate sensitives are now seeing some amount of profit taking. They were the big movers in the last quartile of the calendar year, 2023. But now a little bit of money being taken off the table, which is not a bad thing. Autos, banks are seeing some profit taking. In autos, in fact, the numbers have also been on the weaker side. This morning, Hero MotoCorp will be reacting to its earnings, to its sales rather, where there's hardly been any growth in the December sales this time around. But the space to be in for the last, a couple of days has been Pharma. A lot of Pharma names sitting at fresh 52-week highs. So I wouldn't be surprised if there is some incremental buying in many of these names. Now, there are a couple of things in focus today. The Adani Group stocks will definitely take center stage as the Supreme Court will be delivering the verdict on the Adani Hindenburg case. So there could be some sentimental reaction over there. We'll, react to that closer to time. But apart from that, if you look at what's happening across the globe, not only are the equity markets a bit volatile, you have the currency markets and the commodity markets which are volatile as well. So crude prices are all over the place. The situation at the Red Sea remains a bit tense now with, the latest updates from Iran, etc. So that has put a little bit of pressure. Brent crude, in fact, now at $76 a barrel. But let's see how it goes this morning. The GIF Nifty indicates that the start will be on a slightly weaker side, so about 80 points lower after what we saw yesterday.
So plenty of caution across the board that we're seeing. I mean, just to take off from the point you made on Brent, I mean, yesterday there was so much news coming in. There was negative news on the macros because fundamentally speaking, the Chinese factory data, at least the official numbers, they were weak. The Eurozone PMI numbers are showing contraction, 18 consecutive months of contraction. So the macro numbers have been weak and there's a question mark on demand. But then you have the risk premium, geopolitics. So yesterday, a couple of things happened. First is that Maersk pulled out of the Red Sea. I mean, Maersk was showing some sign of trying to get back in, but one of their ships came under fire and they said, we're out. So that was one. And then Iran went ahead and deployed a destroyer in the Red Sea, and that suddenly got everybody to take up notice. So intraday there was, that fall, that rise that came in, but then the fall came in because of the weak demand positioning. That's on crude, but the bigger issue is now we're getting global markets back. So what's the mothership doing? The mothership decided to fall off yesterday, particularly the Nasdaq. Apple tumbled 4%, and that's because of the Barclays downgrade. Barclays saying that demand for new iPhones, etc., is not that great. And that the street took notice of that, though volumes are even thin on Wall Street. So when you take that with a pinch of salt, but the fact is the Nasdaq sold off, these big tech stocks sold off. And then let's talk about the US bond and currency markets. Even there, the start was quite bearish. The 10-year yield started the year 2024 with a rise of about 9-10 basis points, moving to above 3.9%. Remember the last week of 2023, we kept saying the yield is about 3.8 thereabouts. So there's a rise that came in, not just on this, on the dollar. Dollar was a bigger mover, actually. The dollar fell 2%, the DXY, in all of 2023. Yesterday, in one day alone, the dollar was up 0.9%. In one quick swoop, it made that move to 102 plus. Even this morning, 102.16 is what we've got. So again, I'm taking this with a pinch of salt till we get more cues. And the cues will come in this week because we have the non-farm payrolls data on Friday. We have the Fed minutes coming through as well. Then we have the private sector employment report, the ADP report on Thursday. So there's plenty of data and more participation. So I think by the end of the week, we'll have a clearer narrative in terms of what is the directional call that the US market is taking. Coming to our own market, as we've been saying, perhaps we've kind of preempted a bit of this fall. The recovery from the lows was very heartening for the Nifty, not so much on the Bank Nifty. And I think that's where at least I'll be completely focused on what the Bank Nifty does next, because that remains the most volatile and most vulnerable part of this market. Just some levels. I'm watching out for the lows of the last couple of sessions quite carefully because there's been this interesting, drama around these levels. December 31st, that's when the market showed the first sign of halting. The low was 21,676. January 1, we were still around that vicinity of 21,680 thereabouts. Yesterday, the intraday dip was far sharper. We broke the December 31st and Jan 1 lows, fell all the way to 21,550 thereabouts. But then we recovered from there to close again just around this level of 21,670 to 680. Question is whether we can, retain that. I mean, and for reference, the 20 DM is still lower from where we are. But I think it puts us in a very, interesting and slightly delicate position given the volatility that we've seen, Nigel.
Well, global cues as well, a little bit sketchy in the last few days as well. Things have been quite volatile. But for me, the Nifty Bank holds the key for today. It was the pain point yesterday. It didn't pull back even when the markets pulled back. And today it plays out weekly expiry. So that's going to be the most important index for the day. And obviously, it has the fair bit of weightage out there. And in the last few sessions, quietly, the Nifty Bank has actually corrected. It's corrected closer on 1,000 points. I'm looking at the highs that we saw on 28th of December and yesterday's lows as well. A clear 1,000 points, that's more than a 2% pullback is what we saw on the Nifty Bank. And it's very, very close to around the 20 DMA. If it wants to support that, take support out there and see a bit of an intraday bounce as well, then maybe a long trade will help you in terms of the Nifty as well as the Nifty Bank with your stops in place as well, because it's very, very close to the 20 DMA. Yesterday as well, the Nifty Bank was low and you had a big open interest build up, telling you that shots are getting piled on the Nifty Bank. As I always say, shots getting piled up on any index is not such a bad thing because that gives you an additional reason in case there is a bit of a short covering bounce in store. How the FI is positioned though, they continue to remain net longs. Yesterday they added mild net short positions in comparison to net longs, though currently the positioning is still 68% to the long side, short side at around 32%. Options data comes up for you on the screen on the Nifty. 21,700 call, the 21,500 put. Both of them fairly active in yesterday's trading session, which brings us to the levels. The recent high, a few sessions ago, we saw 21,834. That's going to be the important resistance zone on the upside. Though on the downside, yesterday we took support at 21,555 and we bounced up there. Looking at yesterday's low, looking at the options data as well, that becomes a crucial support zone, 21,500, 21,550. If that level breaks, then maybe we want to visit the 20 DMAs, which is 200 points lower from there. The gift Nifty suggesting a pullback, you're going to be starting closer to yesterday's low. So in case, you have the appetite, you want to put a 50-point stop loss from around the 21,500 odd mark, maybe intraday you see a bit of a recovery. Whether it sustains or not, that time will tell. But the Nifty Bank, that's the most crucial one today. Has it corrected this 1,000 points? And does it want to pop up a couple of 100 points? Let's see whether that happens. But that's the crucial index for the day. Didn't recover yesterday, holds the key for today.
Okay, well, let's also take a quick look at what's happening on the rupee. So yesterday, just pull up the rupee. Yesterday, the rupee closed at 83.32 to the dollar. There was an interesting Goldman Sachs report that came out which suggested that the rupee may see a lot of strength in 2024 and may rise to 81 to the dollar amidst robust inflow hopes. So that's the Goldman Sachs report. But there's also a view that we're getting on the rupee this morning. Kunal Sodhani of Shinhan Bank says that the dollar index recovered significantly as yields rose and saw a risk-off market mood strengthening its position against peers. The December jobs data in the US will define trends. Oil prices cooled off as well. Flows continue to dominate the dollar-INR pair, and he sees 83.20 act as a support, while 83.40 acts as a resistance.
Okay, on bonds, Neeraj Gambhir of Axis Bank says during the week, 10-year benchmark yield traded in a narrow range of 7.17, 7.21% in absence of any domestic cues. The 5 and 10-year GSEC auction results came in better than expected as participants remain confident about FPI inflows in January. RBI announced the fourth quarter of 24 SDL calendar to the tune of 4.13 lakh crores, which was higher than market expectations. On the global front, bonds remain in a narrow range due to the year-end holiday season. Neeraj is expecting that the 10-year benchmark bond yield will trade in a range of 7.15 to 7.25 ahead of the FOMC minutes, as well as the non-farm payrolls data, which comes out later this week.
Well, that's about trade setup, but we got plenty of stocks that we're going to be tracking for you in a special top 10 segment. So let's run you through the list. We're looking at Shah Metallics, Hindustan Zinc, MOIL, VST Industries, Strides, Yes Bank, Bank of Maharashtra. All of them will be reacting to positive news flow, while on the flip side, Hero MotoCorp, Avenue Supermarts, CSB Bank will be reacting to negative news flow.
All right, well, the market has seen volatility not just in ours but across the globe as well. Let's find out how to approach it. Dean Kim, the head of global research products at WilliamO'Neill.com, is joining in now. Dean, thanks a lot for joining in. How are the charts looking? Do you think the start of 2024, which has been quite volatile, is something that could continue through the course of January? And what is your view on the Nifty now?
Yeah, thanks for having me on. Happy New Year. Basically, from a massive rally from October to year end, we're seeing a bit of profit taking by the market. Both S&P and NASDAQ were overbought as we approach the year end, but the RSI is starting to cool off from overheated levels. So far, the move last week and today seems constructive as both indices needed a breather before they can resume the uptrend. So now the ideal situation would be for the indices to catch support at the 21-day moving averages. But assuming that we do that, then I think we're in a very healthy environment. Despite there's a lot of moving parts in the market, but we're taking this in stride, and we think the cool-off is definitely warranted.
All right. Hi, Dean. Morning. Good to see you in, and wishing you all the best for 2024. Dean, could you give us the levels, though, in terms of the U.S. markets? If you're going to pull back a little bit, to where do we take support, if you want to point out a level? And also on the Nifty, how do you see things shaping up? We're holding around the 21,600 odd. Do you think we go down and visit the 20-day MA even in our markets?
Yeah, I think the S&P next support that we're seeing is 1% below at 21-day moving average. And resistance is at 4,800, which is the recent high. As far as the NASDAQ, we're kind of sitting at the 21-day moving averages currently. And the next support, there's some price support at 14,500. That's about 2,000 below. And then we're looking at 50-day moving average. As far as sensex, I look at sensex, we're right around support at 10-day moving average. Would be fantastic if we can bounce from here. Should we go below that, then the next support would be at the 21-day moving average. That's about 2% below. And so we'll see how it goes. But there's definitely should be a lot of support at the 21-day moving average.
Okay, expecting markets to take support at the 21-day level. Dean, hi, good morning and Happy New Year to you. Do you look at the banks here in India, the Bank Nifty index or individual names? Because that's really been the problem spot for us. And we saw lots of selling even yesterday. What do you make of things, and what would you advise here?
Yeah, it's interesting. Definitely, I could see from the relative strength, it is weakening. However, at William O'Neill, we look at other factors such as money flows. And actually, we're seeing pretty good money flows into financials. So I would say HDFC Bank, it's an opportunity. It's breaking out from a double bottom base, and money flows are pretty strong. And so despite, this could be short-term profit taking here, but I think the chart looks good, as well as IndusInd Bank, Yes Bank, and State Bank of India. Those are the ones that I would look at on the larger cap side. And then on the smaller cap side, there's a lot of consumer finance related companies like Muthoot Finance, Intellect Design Arena, Cholamandalam, and Shriram Finance. So those are the ones that I would take a look at because they're all breaking out from like early stage basis. If you see an uptick, in the coming days, I think that's a perfect entry. So I would just, keep it in mind and keep it, on the radar.
Okay, that's interesting. So you like HDFC Bank, and the charts of IndusInd Bank, Yes Bank and SBI also look good. Got it. The space that everyone is in nowadays is pharma. So many pharmaceutical stocks at fresh 52-week highs. Anything that you like from that space?
Yeah, I was looking at JD Chemicals as well as Kaplan Point Labs. I think these are two that looks like a pretty good opportunity. They're sort of early stage based breakouts, and so I would focus on those two.
All right, Dean, we will leave it on that note for this morning. Thank you very much for weighing in on the way we've started off the year. Wish you a fantastic 2024 and look forward to more conversations through the year. We do need to take a quick break on that note, come back on the other side, and of course all the top stocks that you need to watch out for this Wednesday morning, coming back in just a bit. Welcome back. As promised, we are here with the top 10 list of stocks that you need to watch out for. Our entire team is standing by for exactly that. Guys, good morning to you. Sonia, we're not done with the auto stocks just yet, right? The last of the numbers trickling in. Hero also missing the mark?
Yes, and by a margin, So I'm going with red on Hero MotoCorp because they came out with their sales numbers yesterday, well below what the street was estimating, and barely any growth that we've seen in December. Just an indication that there is moderation in sales of two-wheelers that we're seeing, especially the ones that have an exposure to the rural market. So if you just look at it, in December 2023, they sold 3.93 lakh units. This is well below CNBC-TV18's poll of 4.33 lakh units, and this is also slightly below what they did same time last year. Now, scooter sales are fine. There was marginal growth of around 5% in scooter sales, but the motorcycle sales have barely grown. In fact, not grown at all, at just about 3.54 lakh units. But the management is quite optimistic in their press release, as they generally are. They expect the positive momentum in sales Q4 onwards, and they say that the rural sentiment is picking up slightly. But I'm going with red because overall, the sentiment in the auto space is that of profit taking.
Okay, all right. Going with red on Hero MotoCorp. But Mangalam, DMart came out with its operational update as well. How did it look?
Well, optically, it's a 17.5% growth that we're seeing on DMart. The standalone revenue for the company is 13,250 odd crores. Quarter on quarter as well, there is a growth of 7.6%. But the reason why I would consider it soft is because, one, the revenue growth has been below what the company has been historically growing at. The 4-year CAGR has been close to 21%. Quarter on quarter, the revenue growth, of course, has been led by the festive season. The festive season shifted in the third quarter this time around. And the store addition as well has been 11.5% year on year. So that's telling you that same store sales growth implied could be around 6.5% on itself. The other softer aspect is the company's added just around 5 stores this quarter. That means that this year so far, they've added 17 stores. And that's a lot short of their 40-store target of this year itself, leaving nearly 23 stores to be added in the fourth quarter itself. What is it that is important to watch out for DMart? The non-FMCG high-margin business, that is still pre-COVID in their overall mix. And the stock, despite being an underperformer, is very close to its 52-week high. So maybe some red on DMart.
Right, some red on DMart. Got it. Thanks a lot for that. Abhishek is with us to talk about Shyam Metallics. Abhishek, morning.
Morning, Sonia. So, Shyam Metallics sources do tell us that they have launched QIP. The base issue size is about 1,152 crores. Along with green shoe option, it would be around 1,385.3 crores. So, the indicative price is about 576 per share, which is at a discount of 10.4% to yesterday's closing price and about 3.5% discount to SEBI floor price as well. Total dilution with green shoe option would be about 9.4%. The sole manager to this issue is ICICI Securities. Back to you.
All right, Abhishek, thanks a lot for that. So we'll keep an eye out on that stock. Well, I'm looking at 2 stocks, Moil as well as Hindustan Zinc. Let's start off with Moil. They've come out with their December production numbers as well as the update year to date, that is for the fiscal so far. In December, they've delivered their best ever production numbers of manganese ore. The production number has come in at around 1.85 lakh metric tons, which is up close to around 30%. And year to date as well, both their production and their sales numbers are up more than 40%. So going with green out there. Hindustan Zinc, that's the other one that we're looking at. They've come out with their operational update. The mine metal production was up close to around 7%. However, the integrated saleable metal, that was up only around 1% because of greater focus on lead in comparison to zinc. But the good news is silver, that's shown a big growth of close to around 22%. We know pricing has been strong. And in fact, if in case they go ahead and do some kind of corporate action where they separate the silver business, you'll want to see a bigger ramp up out there. And that's precisely what's happened. So I know the dollar index has moved up overnight, but maybe if you look at these numbers, you'll say it's more good than bad.
Okay, so dispatch numbers looking good for the miners. Back to Mangalam then to discuss some of the block trades that happened yesterday. And VST was a really interesting one. So buyers and sellers, Mangalam?
Well, for VST Industries, the stock was up 20% after the last trade yesterday, and we did, point out that there could be some HNI buying out there. HDFC MF was the one which sold about 2.5 lakh shares, so their stake is down from closer to 7% to just about 5% DSP MF is the other seller, about 2.5% was their stake earlier. That has come down to around 1.1%. But here's the interesting one. The buyer is Radhakishan Damani. He's bought about 2.23 lakh shares, which amounts to about 1.5% equity. The other one is SBI MF, which is bought about 1.5% in terms of equity as well. With this purchase, Radhakishan Damani's stake in the company increases from near 33% to close to 34.34%. So that will be the key to watch now. Fundamentally, will there be recovery in their cigarette volumes and gaining in market share? Whether DSP MF and HDFC MF will sell more from here, and will RKD family buy more? And if they do, would that perhaps trigger some sort of an open offer or not, is something we'll be watching out for VST. The other one is Strides, where Amansa Holdings has bought about 1.35% stake at close to 660 rupees per share. This looks like a fresh entry into the counter, so we'll watch out for that too.
Okay, and now we all know why VST Industries was up 20% yesterday. RK Damani buying more stake there. Thanks a lot for that, Mangalam. But Abhishek is with us to give us some updates on the banking space. Abhishek, over to you.
Well, Sonia, to begin with, Yes Bank came out with its operational update. They have lost market share on a YOY basis. Sequentially, it looks like a good business update. So deposits are up 13.2% YOY and about 3.2% sequentially. The CASA ratio has improved on a sequential basis by 25 basis points to about 29.7%. Advances growth is at less than 12% YOY, but sequential growth is more than 4%, which has actually helped the CD ratio improve on a sequential basis. Bank of Maharashtra, the strong loan growth actually continued. Deposits are up nearly 18% YOY and about 2.7% sequentially. They have lost out on CASA ratio, which has declined both YOY and quarter-on-quarter comparison. Advances growth is at 20.3% YOY and about 3% sequentially. The CD ratio calculation shows that it has improved both YOY and quarter-on-quarter. CSB Bank, they have focused on deposit growth, which has knocked off the CD ratio, and there could be pressure on net interest margin as per the provisional numbers. So deposits are up 20.65% YOY and about 7.5% sequentially. The CASA ratio has declined both YOY and quarter-on-quarter. There's a massive decline over there. Advances growth is at 22.6% YOY and about 1.8% sequentially. There is a dip in advances growth. If you take a look, Q2 sequential growth was about 5.5%. So loan growth has moderated over there. The gold loan portfolio, that's trimmed down in terms of loan growth as well. Sequential growth in gold loans is just 2% when compared to 5.5% that they saw in Q2. CD ratio has knocked off sharply, 83.6% in Q3 FY24 when compared to 88.3% in the previous quarter. So there could be pressure on the net interest margin on account of the sharp rise in deposits. Back to you.
Okay, all right, Abhishek, got that. Thanks very much. By the way, speaking of banks, in general, we're watching out for the whole sector because of the RBI rule that came in with respect to dividends. And we'll discuss this in more detail as we go along. Essentially, what the RBI is saying is that now the amount of dividend that banks can pay out is going to be mapped with their NPA levels. And they've done a whole gradation. If a bank has 0 NPA, then the dividend payout ratio can be as high as 50%. If the NPA is between 1% but less than 2%, then there is a certain bracket in which they can pay out dividends. So basically, the amount of dividends being paid out by banks, PSU, private sector, even foreign banks, the dividends that local branches are paying to their parents, international parents, all of that is mapped to the amount of NPA level in the bank. How does this impact the sector? We'll discuss this, of course, in more detail with our experts. But a quick recap of the list of top stocks to watch out for. The ones that have positive news flow around them are Shyam Metallics, Hindustan Zinc, Moil, VST Industries, Strides Pharma, Yes Bank, Bank of Maharashtra. That is on the back of positive news flow. Hero Moto, Avenue Supermarts and CSB Bank are the ones that we'll watch out for. They could potentially open out in the red.
All right, well, those are a couple of stocks to watch, but there are a lot of brokerage notes that have come out this morning, very interesting ones at that. So Sudarshan is joining in to tell us what he's picking up. Sudarshan, over to you.
So I'll be talking about 2024 outlook, and today I have three sectors. First one is Jefferies on industrials. It has a buy call on 8 out of 10 stocks. Top picks are L&T, Siemens, Thermex and KI Industries, and it has a sell call on BHEL and Cummins. It says operating leverage surprise should continue in 2024, but upcoming budget signaling government capex slowdown might be a potential negative. Indigenization focus and the capex should help industrial stocks. Next is Jefferies on banks. It likes Axis Bank, ICICI, IndusInd, HDFC Bank and SBI. It says valuations are attractive for growth and return on equity. Banks can look for broad-based growth in SME and housing, but they will need to maneuver around slower deposit growth, rate cut and elections. Next one is Bernstein on power sector. It says heading into an election year with valuations at 10-year highs, question is whether it is time to book profit or continue to hold. It still sees upside in NTPC. For NTPC, it sees catalysts in lower delays in plant commissioning, order placement for new plants, and wins in renewable tenders and favorable regulations. Back to you.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's hop across to Manisha, who's joining us to tell us what all has gone on with commodity. And Manisha, plenty, right, overnight?
Oh, yes. And I'll start with the crude oil prices, where we have seen 2% of a decline coming in the overnight markets as the street shuts off on what's happening in Red Sea and decides to look at the sell-off in the risky assets. And we've seen equity markets decline in the last 24 hours. That was weighing on. And then there has been a rebound in dollar, in treasury yields, and that continued to weigh on as well. There is increasing global supplies from the non-OPEC producers, and that is telling you that there's going to be more crude available in 2024 than the demand can catch up with. Also, while there is a lot of happenings on Red Sea with Iran deploying warship, but there is, the analysts believe that it's unlikely that Iran will engage with U.S. warships. And with that thought process, we have seen the premium come off as well. The OPEC and allies next meeting is in the month of Feb. That's going to be the next most watched event. And ahead of that, it also is about the U.S. non-farm payroll data that comes in on Friday. So ahead of that as well, we are looking at some jittery markets here.
All right. Thanks a lot for that update, Manisha. Well, moving on, the union budget is less than a month away. What is your wish list for the finance minister? Presenting the CNBC-TV18 budget ballot box coming to a hotspot near you. We will be placing these ballot boxes at popular public spots like malls, colleges, theatres and others across major cities. We'll also be asking the newsmakers who drop into our studios for what their budget wish list is. So come join us. Tell us what your top budget wish is from the finance minister. Drop your wish list at a CNBC-TV18 budget ballot box near you. We will compile them and present it to the finance minister before she presents the union budget.
Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good morning. Though for starters, the GIFT 50 is suggesting that we pull back a little bit. Maybe a 70-80 point downtick is what we could see at the start of trade. But we've listed down all the top stocks that you need to track. Let's get some fundamental analysis going with our expert. We have Devin Chauksy, MD at DR Chauksy FinServ, who joins us on the show. Hi, Devin. Before we start talking about stocks, first want to wish you all the best for 2024. It's the first time we're speaking in the new year. So Happy New Year to you, your family, and your entire team as well. Devin, we just listed down a few stocks, and Hero MotoCorp was one of the stocks that Sonia told us that the operational numbers that came in, the sales numbers for the past month, was a little bit disappointing. And we know that there is still some pain at the bottom of the pyramid. That's in rural India. What's your view on the stock from here?
Hi, Nigel. Good morning and wish you all Happy New Year as well. Well, I think nothing wrong with the fundamentals per se as far as the business outlook is concerned on the two-wheeler industry. On the contrary, I believe that these particular times are relatively better times for the rural India. The demands have actually stabilized, and probably I think they are likely to see relatively better traction going forward. Of course, I think the month of December is something which one can possibly argue that yes, this is not the number that one was looking for. But the fact remains that I think the overall environment in the rural India remains, I think, extremely positive. And that promises to remain, I think, positive for the longer period of time. So from that perspective, I think we should be seeing the growth in the business, both in two-wheeler as well as in four-wheeler, particularly in the entry segment. I think we should be seeing that particular growth continuing. Maybe I think the percentage-wise growth may somewhat taper down, I think, over a period of time, because I think the demand scenario remains consistent as against, I think, the lumpy scenario that we had seen in previous years. So to a greater extent, I believe that I think the steady growth prospects are definitely built into in the rural area, and where probably likes of Hero MotoCorp would be possibly better placed going forward, given the kind of steady growth and the demand continuing for that.
Devin, hi, good morning. But, you know, this question also ties in with what's happening with some of the other companies that have rural exposure, right? Not rural, maybe semi-urban, like DMart, for example. Weak numbers coming through over there as well. Mangalam was telling us that, you know, the revenue growth that they've seen is below the 4-year compounded growth rate at about 20%. So I wanted your thoughts on this entire piece, the rural piece, and what do you do with a stock like DMart now?
Yes, Sonia, good morning. Well, I think that's true, that I think when you look at the compounded numbers, I think these numbers are not looking appealing. And that's going to be the case going forward because the base effect has actually gone up. And on a higher base effect, I think the growth assumed would be, I think, a steady rate of growth and not, I think, the rate of growth which these companies have seen in the previous years. So that's a realization which is coming in across the board, I think, for most of the companies. Should this be the realization, then one would remain confident that the growth will continue, but not at a speed at which it, or not at a margin in the percentage at which I think it used to be. So to a greater extent, I think one will have to taper down the expectations of growth going forward. I believe that I think the organic growth will have to happen by way of, I think, systematic expansion into the business. And that is where probably, I think, most of the companies will try and make extraordinary attempts, including likes of GeoMart. We'll see this particular situation coming up for many companies. That also means that I think we are also likely to see some of the disappointing performance from the mid-tier and the smaller companies in this space. So we'll have to accept the reality that if these stocks have run up ahead of time and they are quoting at a valuation which is expensive, probably I think some amount of moderation in the valuation, rationalization in the valuation definitely is expected. It may not be the price correction, but it might be, I think, the time correction which we'll have to experience in many of these companies which are quoting at a premium valuations.
Okay, well, that's the take on DMart. Stay on there when we have more questions for you, but we also have to quickly, get to a management conversation now. The stock in focus is PG Electroplast. It's had a pretty good year, gain of over 100%. And we're just coming off the festive season, the third quarter. Vikas Gupta, MD Operations at PG Electroplast, is now joining us to give a sense on demand. Vikas, thanks very much for being here with us. Season's greetings and wish you a very happy new year. Now, your product range pretty much encompasses, a whole variety of electronics from, TVs to, room ACs, etc., washing machines. So I guess you can give us a good sense in terms of how demand played out as we went through the festive season this year. What was the overall traction that you saw in Q3?
Good morning and Happy New Year to you and to the entire team at CNBC.
Thank you.
The festive season was pretty good. Typically, in the festive season leading up to Diwali, the sales for washing machines and televisions pick up momentum. And we were able to cater to the demand of our clients. And we saw a robust growth in our numbers, especially in our television business and washing machine business. So we were happy with the numbers that we achieved in quarter three. incidentally, we are in a quiet period, so I can't give much of the details about the quarter three performance.
No, I understand. So won't push you on the number, but just in terms of, understanding the sentiment, you had a very strong Q2 itself. I mean, in Q2, your top line was up 40%. So now when you compare this festive season over the previous year festive season, is the growth as strong? I mean, are we talking such heady numbers? Or would it be, perhaps a little lower than the kind of growth rates that we saw in the second quarter?
I would suggest that it will be difficult for me to give the specific numbers. Yeah, definitely, we had a decent growth. Exact numbers we'll share with you as and when we are able to do that.
Okay. So good morning. Vikas, good morning. Just to take Surbhi's point forward, right? I mean, earlier you had put out some numbers. So in the room AC business, for example, you had said that you can generate 1,500 crores of revenues in FY25. Are you on track to hitting that target? And what is the kind of average growth that you see by the end of FY24? Just some ballpark guidance on how things are going, particularly in room ACs.
So, Sonam, please understand, in room air conditioners, we are standing with the guidance of around 1,400 to 1,500 crores that we have given earlier. On the top of it, please understand, there has been a moderation in the average selling price for the air conditioners. That has been particularly led by the softening of the commodity prices. There has been almost 8 to 10% moderation in the average selling price of the air conditioners from our side to our clients. And nonetheless, we are hopeful that we should be able to maintain the momentum and reach the level of around 1,400 to 1,500 crores in our air conditioner business.
All right. Hi, Vikas. Good morning. Nigel on this side. Always good speaking to you. I recall in the last few years, the stock is up more than 10 times. So now, the onus is on you to come up with something new to excite the street. And one thing that you all have done is that JV with the China group, right, for TV sets. And you've been quite optimistic on that. I think the last time you joined us, you were telling us that you're expecting it should contribute maybe 250 to 300 crores in the time to come. But I was looking at a brokerage report that's from Incred, and they're saying that it's going to be challenging for you to ramp up out there because other bigger players like Dixon already has 60% of the market, already has a big capacity as well. So what is your volume targets at least that you're looking at? Say by FY25, I think the capacity you'll have is more than 1 million. You could correct me on that number. But how do you see volume spike up in this TV sets business?
Good morning, Nigel. So please understand, the JV that we have put up with China Group, we are quite confident about the momentum of growth that we can achieve in our television business going there in that JV company. We are putting up a capacity of 1 million pieces there. And in first year of full operations, that we are anticipating that we should be able to achieve a revenue of almost around 500 crores in that company itself.
Okay, and in million units, how much would it be out of this 1 million that you're going to do? For FY25, say, can you do around 0.4, 0.3, what will it be?
So I think it should be almost 500,000 or more than that we're talking about.
Vikas, while I know that we can't talk specific numbers, but as you look at closing out FY24 and then stepping into the new year, in terms of your product lines, which one is showing the maximum traction and momentum in terms of revenue scale up? And is it televisions? Is it going to be room ACs? Room ACs, you put up that new plant in Rajasthan as well. I think it was commissioned very recently. So just tell us the capacity utilization levels and the ramp up. I mean, how much will you ramp it up as we get into summer?
For us, all the product categories are firing in, and we are confident of achieving a decent growth in our air conditioner business, in washing machine business, and electronics business as well. Our Bhiwadi plant in North for air conditioners will start production in this month, and we are confident that we should be able to achieve some decent numbers for AC business from our new unit. We are coming up with the window air conditioners from our new unit in Bhiwadi, which was missing in our product lineup. So that will augment our product offerings to our clients in our air conditioning business.
All right, we leave it at that. Thanks a lot, Vikas, for joining in. Have a great 2024. You have generated a lot of wealth for shareholders. I mean, your stock price has more than doubled in the past 1 year. Hope you continue to do that in the days to come. But let's talk about the markets now. Anuj is joining us this morning to talk about all things that have transpired in the last 48 hours. And Anuj, the one thing that stands out is volatility, right, which has kicked into the market. Do you think that could be a sign of a changing trend, or is it too soon to call that?
Well, we'll wait for the market's verdict, Sonia, but, I've been cautious for the last couple of days because of 2 or 3 telltale signs. The series, for example, started with a stock in F&O ban. Normally, that's a sign of exuberance. And in 3 days, 6 stocks have actually come in ban. I wrote 5, but actually 6 have come in ban. And yesterday, the Nifty and the Bank Nifty both broke the opening day low of the series. That's normally another sign of getting a bit cautious. And January in general has been a volatile series. I mean, if you look at the last 4 or 5 years, it's generated negative returns. Not by a lot, but generated negative returns. So in that sense, there is some volatility. And there's been some warning from the global markets. Dollar index and bond yields both are showing some signs of reversal, maybe because the market's expectations of a rate cut coming as soon as March perhaps was slightly ahead of reality. So that could be one reason. In terms of cues to track, the most important cue overnight was the big crack in Nasdaq. Considering that was the leading market of 2023 with 45% gains, you want to give it some importance. Nifty's low yesterday is crucial because that was exactly at the 10-day exponential moving average, and the 20-day exponential moving average is placed at 21,213. The Bank Nifty broke the 10-day and the 20-day exponential moving average is placed at 47,300. And one more thing, only Pharma did well yesterday, 2.5% higher for the index. So I'm not saying that the market's collapsing or anything like that, but clearly there's been some profit booking at higher levels. In terms of Nifty levels to watch, I'm watching out for 2 support zones. First is 21,535 to 21,555, which is the 10-day exponential moving average and yesterday's low. And the big support really comes in at 21,450 to 21,500, the option zone. I guess the Bank Nifty, which is proving to be a bit of a problem point once again. After that mini breakout above 48,000, it actually broke the 10-day exponential moving average, and here we are watching out for 47,500 to 47,600 and then 47,300. Keep in mind, you need to watch out for the behavior of HDFC Bank and ICICI Bank. While HDFC Bank still remains quite strong, ICICI Bank is the stock which is getting a bit weak, and yesterday broke some crucial levels like the 20-day exponential moving.
Absolutely. Take your point, Anuj. I guess we're really watching for the banks. Just speaking to Deemkin on the technicals, I mean, he was quite convinced that the charts are still looking good for the likes of HDFC Bank. Let's see how this plays out. Speaking of banks, actually, let me take that question to Deven. Deven, hi, good morning and season's greetings to you. Wish you a very happy new year. Just your thoughts on the fact that the struggle continues for large cap banks, right? It's the whole market's waiting for this big move and a sustained move on banks to pick up, but we are yet to see signs of that. And also throw in a word on the RBI draft circular that came in yesterday, where the Reserve Bank is saying basically tying down how much dividend you can pay out with the level of NPA. If the NPA is above 6%, banks can't pay any dividend at all. And then there's a whole gradation that the RBI has done. Would that have any sort of a sentiment impact, particularly on PSU banks? Because in the bad NPA cycle, I mean, we know how high those levels can go, and that just means that the whole dividend aspect of owning a PSU bank, that goes out of the window.
Absolutely. Good morning, and wish you a happy new year as well.
Thank you.
Well, overall, I believe that I think the shuffling in the banking counters, I think, is basically creating this kind of a situation. Earlier, I think the sale-off took place in ICICI Bank, buying took place in Axis Bank. Now, even the profit booking is taking place in Axis Bank, and I think the buying is going and shifting into banks like HDFC. So it's a counter shuffling which is happening in the portfolios of most of the investors. And that could be the resultant outcome of, I think, whatever we are experiencing currently in some of the banking stocks. Also, I think the private sector banks, which probably will reach their price to perfection ratio, I think some amount of profit booking was justified, and that money shifted into some of the public sector banks in the last 2-3 months. And that's where probably I think one saw the kind of a movement also in the public sector banks. So typically it's more of a money action that is playing out, or this is being played out, I think, in the market at this point of time. I don't think fundamentally things have shifted beyond the point to any one of these banks, and I think they remain extremely strong as far as I think the loan growth portfolio is concerned. Even for public sector banks, I believe that their ability to manage the non-performing asset is far more stronger than ever before. And at the same time, I think the balance sheets have remained, I think, cleaner than they were in past. So from that perspective, they are partly justified in getting re-rated at this point of time. I don't think that RBI circular per se is going to materially impact some of the quality public sector banks. Maybe I think mid to small size banks, I think maybe slightly more vulnerable compared to the larger banks who are probably managing their non-performing portfolios well. So to a greater extent, I think, to me, I think this event should be remaining muted event, even though I think it may sentimentally have some say, but it should be muted event as far as balance sheet is concerned.
All right. Well, just stay on. We'll come back to you in a bit. For now, let's take a quick commercial break. When we come back, we also have the pre-opening rates. Mitesh Thakkar, Kush Bora will be joining in for a quick technical check of the market. Stay tuned. Welcome back to Bazaar Morning Call. Well, now we're going to talk about the technicals of the market. There's some amount of volatility that's kicking in. So how do you approach it? The implied opening suggests a cut of 72 points. Mitesh Thakkar and Kush Bora join us now. Gentlemen, morning to both of you. Kush, I want to start with you. This is a bit of a tricky start, right? But through the course of 2023, every dip was a great buying opportunity. Do you think this time will be different?
Hi, Sonia. First, a very good morning. Well, I think it'll be the same as 2023. Perhaps it's just, what we got used to was one swift, sharp day of correction and then a recovery. Perhaps that will change at least in the first half or at least in the first month of 2024. But otherwise, I am of the belief that, all these dips will still continue to be as, a buying opportunity. So it's just a matter of, when the markets rebound and from where they do and not if. That said, if you look at the Nifty setup, it's playing on cue right now. It's just a little flat. My bigger concern is the Bank Nifty, which is also in fact playing out as per script. The weakness was evident on the charts and on the option side. And today being the weekly expiry, I think the pressure will continue because the call bases have shifted lower. So if the 20-day moving average is not held, we could slip to 47,000, but that's the worry. But as I said, in the grander scheme of things, I think these dips will turn out to be a buying opportunity for the months of February and March.
Okay, Kush, hi, morning. Stay on with us. Let me bring in Mitesh as well. Mitesh, hi, morning to you too. So lots of volatility. Global markets very, very cautious. How would you approach things today?
Yeah. Good morning, Subi. So yesterday, I was of the opinion that we'll see a deeper pullback, a stronger kind of profit booking movement than what we have seen in the last couple of weeks. This time I'm looking at a test of 21,500 and even in the worst case scenario, maybe a test of 21,200. And on the upside, it will be difficult in the short term for the Nifty to get past 21,800, 850 zone. So I think very clearly you have a bias which is slightly volatile, choppy, but marginally on the downside in the short term. And around 21,200 is where I think, this entire pullback could end. And then we might see a reversal. So for the time being, slightly trading with a negative bias. On the Bank Nifty as well, the levels are 47,500 is the near-term target on the downside, which I'm looking at. But also there's a good possibility of us heading towards 47,150. So in both the indices, the idea is the same. I think, try to sell at higher levels, get into put options positions, or wait for this pullback to play out before venturing into long side.
All right. What about individual stocks? What are we looking at this morning, Mitesh? Of course, yesterday, I think when we spoke, we were talking about how, Pharma is doing well, rate sensitives are under pressure. Do you see that trend continue into today as well? And what are the stocks to look at?
Very much, Sonia. Good morning. I think today also I have a Pharma stock on my buy list. Yesterday we had about 2-3 calls over there. I think that sector still looks interesting to me. And the stock which I have picked up today is Cipla. Buy here with a stop at 1260 for a first trading target of around 1320. And I have a sell on ICICI Bank with a stop at 993 for a target of 960. That apart, Adani Ports makes on the buy list. There's a Supreme Court decision and event over there. But technically, I think it's looking very strong. So I would venture a buy with a stop at 1055 for a target of 1130. And a sell on iShares, which had a very negative candlestick pattern yesterday. Recommend selling here with a stop at 39.25 for a target of 3800.
Okay, and Kush, let's come to your individual stock trades as well. What would you look at today?
Sure, two of them. First one being Chambal Fertilizers, that's the buy. It's given a multi-month breakout of a rounding bottom formation. So beyond, above 360, 365. Looks like a very strong buy. From a near-term perspective, 388, 395 are the targets we're looking at, but positionally this could also breach, the 430 levels. 373 again in the near term will be my stop loss. Again, from the pharma space, Granules continues to do well even before the whole pharma journey started. The stock was actually setting up for a nice up move and has delivered that. This momentum could continue. Again, for the near term, 430, 440 are the targets, and 410 is where I would place my stop loss.
All right. Well, since you've spoken about pharma, Kush, thanks for that. We're going to take that cue forward. And on the other side of the break, we're going to talk about the pharma sector, which has been hitting fresh 52-week highs. Aditya Khemka, who's the fund manager at InCred Healthcare PMS, will discuss the big trends in the pharma space. Stay tuned.
Okay, we'll start getting our pre-open rates any moment now, and it's a very cautious start. We've been saying that because global markets are in a bit of a pause mode, a little bit of a risk-off is what we saw on Wall Street. Speaking of, regulation and risk, the RBI has come out with a new consultation paper. It's a new draft regulation that the RBI is talking about that will govern the amount of dividends that banks pay out and tie that into the NPA level in the bank. Lata is here to explain. Lata, morning. Good to have you in the studios as always. So basically, if you have less NPA, you can pay more dividends and vice versa, right?
Yeah, well, the dividend payment was always linked to the amount of NPAs. And if you have net NPAs over 7%, you couldn't declare any dividend. You couldn't declare any dividend if you had net NPAs over 6%. Now that threshold has been raised to 7%. It's the other way around.
Okay.
Net NPAs of 7% was the original rule. Now they've lowered it to 6%. But the more important point is that how much of dividend can you declare? Originally, if you had net NPAs of 7%, you could declare only 15% dividend. Now, of course, it has to come down to 6% before you can declare any dividend. But if you have no NPA at all, zero net NPA, okay, after gross NPA, after providing for, if your net NPA is zero, you can declare 50% of your profits as dividend. Originally, it was 40. Usually, you don't have companies with zero net NPAs. It would be normally between 0 and 1%. If you are in that bracket, now you can declare a dividend of 40%. Originally, the limit was 35%.
Also, in that way, it's actually relaxing
at the upper level.
In the brackets.
At the upper level.
Okay.
But at the lower level, to become eligible for declaring dividend, it's become a bit tighter. Originally, you could have even 7%. Now you have to, be as low as 6% to declare even 1 rupee as dividend. The important point is for foreign banks, they have to take permission of Reserve Bank now to
send money
remit
to the
money. Originally, it could be done without permission, but now because there are these stricter rules, they have to take permission. And more than anything else, most banks don't declare 50 and 40% of their profits as dividend. They would rather keep them as retained profit because no bank likes to raise more capital. If you raise capital, it becomes that much more difficult to give a high ROE. And banks, the price depends on the ROE. Therefore, it's okay if it is 40%, nobody is going to use that limit.
Okay, all right, Lata, thanks so much for joining and clarifying all of that to us. Well, let's focus, though, on the sector of the day yesterday. That was pharma. The markets ended lower, but the pharma sector was up and about. To help us out with a quick analysis on that front, we're joined by Aditya Khemka, the fund manager at InCred Healthcare PMS, who joins us on the show. Hi, Aditya. Happy New Year. And it appeared it was a very good start to the year for the pharma stocks yesterday. What's your view? Do you believe that the worst in terms of pricing is behind? Will things look up from here on? How do you see things shape up?
Hi, good morning. Happy New Year to you and your viewers. The rally that we saw yesterday, to my mind, had very little to do with price erosion in US. The pricing pressure that we keep alluding to is largely related to the US market for pharmaceuticals. The data that we see coming out from various agencies still indicate that pricing pressure remains elevated. It remains between mid-single digit to high single digit, which has been the long-term averages. It has cooled off from low double digits that it was, let's say, a year back, but the pricing erosion still persists at a mid-single digit to high single digit. So the rally is not really linked to any improvement in the base business in the US. The rally may be linked to certain, large ticket launches that some of these pharma companies have done in US, for example, Revlimid, for example, Spiriva. But these are 2-3 year cash flows. These cannot be extrapolated to 20-30 years. Remember, most of these pharma companies trade between 35 to 40 P multiples. which implies that the cash flow they are making today should at least last for 35, 40 years. But these large ticket products that they've launched in the US are going to be 2-3 year cash flows, not longer than that.
Since we're talking about multiples, Aditya, the EV to EBITDA for many of these pharma stocks, right, on an average, trading at about 25 times FY23, if you look at it. The historical 10-year average is about 18 times. So would you be concerned about the valuation picture, or do you think that earnings are picking up in tandem with valuations and these levels are justified?
Yeah, look, the fascination that most investors have with multiples like EV, EBITDA and PE is slightly misplaced in the sector right now. The reason being that the last 12 months of FY23 specifically, the cost of the raw materials was significantly elevated because China was not producing chemicals as much as they normally produce. And because of that, the price of raw materials were extremely high, and the margins of these pharma companies across the board were fairly suppressed. Now, when you take EV/EBITDA, the denominator itself is the last 12-month profit, and if the last 12-month profit is suppressed, your EBITDA multiple looks slightly higher than it should be. Remember, multiples make sense only when the profit is in steady state. When it is inflated or deflated, EV/EBITDA or PE multiples do not make much sense. So yes, the multiples do optically appear high, but as you said, the next 12 months, which is FY24 and maybe even FY25, we expect that the profit will grow much faster than the top line because China is now producing full steam and the price of the raw material is declining, which will help these pharma companies to expand margins. And therefore, I don't have a discomfort with the valuation multiples that we spoke of.
You were also talking about Revlimid generic, right? That launch has aided the US sales for a lot of companies, whether it's Cipla, Dr. Reddy's, Natco, Sun Pharma as well. But some of these stocks like Cipla, for example, are sitting at fresh 52-week highs. Do you think the good news is already in the price, or could there be more to go because of Revlimid generic?
So I think Revlimid generic is largely in the price now. I would say it is actually overappreciated than what it should be. Remember, Revlimid is a 3-year cash flow. Sometime in 2026, Revlimid goes generic because the patents expire. But the cash flow that they're making today from Revlimid is probably getting a multiple of 35-40 PE multiple, which to my mind is a highly inflated multiple for a cash flow that is going to last only 3 years. So yes, I think Revlimid and more is in the price today. And for some of these stocks, especially benefiting from large product opportunities in the US, the stock seems to be priced higher than their intrinsic value.
Okay. By the way, just coming in to point out that there are some interesting moves in the pre-open. The Nifty is very quiet and so is Bank Nifty. All the indices are flat. Look at the excitement that is already reflecting on the Adani stocks. In the pre-open, all Adani stocks are rallying. Adani, Total Gas, 8%. Energy is up 10%. Green is up 6%. Enterprises, Sports, Power, everything. The entire Adani group is up and about. That's one interesting trend. The other one is check out VST Industries. Now that we have confirmation on who the buyer was in yesterday's block, and that is Mr. Radhakrishnan Damani, the market's quite excited. In the pre-open, the stock is getting bid up another, it was 10%, okay, now 6%. So that was the other interesting mover. But otherwise, I mean, it's very, very quiet out there. Hero Moto suggesting a decline of 1.5% because those numbers have been pretty dismal, as Sonia pointed out earlier. So those are some of the early indications and trends from the pre-open. But Aditya, just to come back, I mean, if I were to ask you, what is the biggest trend in the pharma space, frontline pharma space, that you'll watch out for this year? And maybe, even in terms of product launches, is there any 1 or 2 blockbuster drugs like a Revlimid, which we had, last year, which could be sort of the defining turning point of 2024 for Indian pharma?
No, so unfortunately, we do not have any visibility on any large product launches in 24 or 25 for most of these pharma companies. There might be a couple of launches here and there, which would be very company specific and maybe 6 months cash flow or 3 months cash flow, depending on the kind of exclusivity that they have. But by and large, there are no large ticket launches happening in the US business for majority of these pharma companies, which is why if you see as a house, as Incred Healthcare portfolio, we are not taking any exposure to pharma companies that have a large exposure to the US business. We are rather more bullish on companies which are branded generics, which means focusing on India and emerging markets, hospitals, diagnostics, and even API companies. So the trend that I see happening in the next 12 months, which will basically help investors to make money, is to focus on companies which have brands, which have sustainable revenue, sustainable cash flow, high ROEs. And these companies will also benefit from softer input costs that these companies saw elevated input costs last 12 months. So the next 12 months, they'll see, softer input costs, which will help them expand margins as well.
Okay. Quickly, diagnostic companies you briefly mentioned. You think the worst is over in terms of pricing pressure, competition, etc. for diagnostic companies?
Yeah, I think that's a slight misperception that there was ever a pricing pressure in diagnostic companies. Yes, there were competitors who launched at cheaper prices. That was a customer acquisition strategy, sort of cost. And I think those online platforms also, if you go back and check their prices now, they've increased prices manyfold. And they're still at a discount to the incumbents in terms of the traditional brick and mortar players, but the discount has now significantly narrowed to what it was when these online players had launched. So, yeah, I think diagnostics will remain a very, very secular growth story. The incumbents will continue to grow at their own pace. In fact, just to let you know, incumbents have actually increased prices after the online platforms started offering these tests at a discount. And the incumbents continue to grow their revenue in a high single digit to low double digit, depending on which incumbent you talk about. And we feel that diagnostic is a branded play. 85% of the market is unorganized. So any new player which comes is very unlikely to challenge an incumbent and rather take market share from the unorganized sector. And diagnostics as a sector has significantly derated post-COVID. So, it's a combination of where, earning growth is going to be solid, margin expansion is going to happen, and multiples can probably re-rate. So we are very, very bullish on diagnostics.
Okay, bullish on diagnostics. Got that. We'll end on that note. Thanks a lot for joining in. Appreciate your thoughts here. By the way, heading into the pre-opening session, so let's get some 9-10 calls going. Mitesh, what's the big call at 9-10?
I had a buy on Adani Ports. I think that would be a good trade. Around 11.25, 11.30, look to take profits there.
Okay, Adani Ports. All Adani Group stocks are up and about. There is a Supreme Court hearing on the Adani Hindenburg case at 10:30 today. So perhaps in anticipation of that, things looking good.
Actually, there'll be excitement more because not just a hearing today, is the final judgment.
Yeah.
And if the market's sentiment is to go by, and we don't want to preempt anything, but the sentiment seems to be saying that, maybe this is going to be a matter finally settled, but it's in the court, so I wouldn't say anymore.
Absolutely, absolutely. Okay, M&M is another stock in focus, so let's get to that. Motilal Oswal actually is very bullish on M&M. They've had a buy all along. Now they've reiterated their buy. The important bit is they have a target price of 2,000, which is a further 21% upside to the current market price. And they say that across all verticals, M&M is well poised to perform well this year. They expect about a 13% revenue growth from FY23 to FY26, and they expect a 14% volume compounded growth for the passenger SUV segment, which has been, the darling segment in the auto pack. That's over FY23 to FY26. They also talk about how FY25 will be a better year for the tractor industry, and on valuations too, it's not as expensive compared to many of their peers. The core PE is 17 times FY25, while a couple of their peers like Maruti Trading are more expensive. So M&M is the top pick for Motilal.
All right. Well, let's focus on a couple of other names. Then Avenue Supermarts, that's the stock in focus. Mangalam joins us to give us a quick revision of their quarterly update. Mangalam?
Well, for DMart, the quarterly update, the revenue that the company posted on a standalone basis was close to 13,250 crores. Year on year, it's a growth of 17.2%, and quarter on quarter, it's a growth of 7.5%. Of course, it is lower than their 4-year compounded average. And the store addition at around 5 stores in this quarter itself is lower than what the street would have anticipated. Let's, look at what brokerages are making of it. Goldman Sachs, they have a sell rating on the stock with a target price of 36.50. They say that growth has moderated despite favorable festive timing, and store expansion too has slowed down significantly in FY24. We have Morgan Stanley saying that operational metrics have improved, but pace of store addition needs to pick up. They have an overweight call with a target of 44.71, and HSBC too has a target of 4,600 rupees on the stock with a buy call. They're saying that the business model is formidable. It just needs assortment overhaul and network strategy reset. Perhaps that is something that the street is looking at.
Okay. And Mangalam, also let's quickly run through VST Industries because the market's excitement with Mr. Damani's name is quite palpable in the pre-open.
Yep, it looks like Mr. Damani will be making a lot of money on his holding in VST after buying yesterday. A 20% up move is what we saw yesterday, and in pre-open it's up around 10% as well. HDFC MF sold about 2.5 lakh shares, so their stake came down from 6.8% to around 5.1%. DSP Mutual Fund sold about 2 lakh shares as well, so their stake has almost halved too. Radhakishan Damani has increased his stake by about 1.44%. Remember, Radhakishan Damani and all the other entities together hold about 32.9% stake in the company, or held about 32.9% stake in the company. That's increased to around 34.3%. Now the question is, will they buy more? The other question is, will DSPMF and HDFC Mutual Fund sell more of their holdings? And will there be recovery in cigarette volumes and market share, which the company has been losing to ITC over the last many quarters?
Okay, thanks a lot for that. Lot of questions there unanswered. VST Industries still up another 5.5%. But let's do one thing. Venugopal Gare, who's the managing director at Bernstein, joins us now. We have a minute to go before the market opens. So let me get a quick comment in from him. Venugopal, thanks for being with us. Do you think this market is getting into a phase where some caution is needed?
No, that's right. Given that the market is just about to open, firstly, Happy New Year to all of you. Yes, my broad, quick answer to that would be that we are probably reaching a situation where we're hitting onto a valuation ceiling. Look, this has nothing to do with being negative on macro or on earnings. It is primarily a situation where we are actually calling to take profits. That's basically what we've been arguing in our Outlook report as well.
Okay, and that very quick note. I think there's just 10 seconds left for the market opening. So, Venugopal, we'll come back to you. But I think, you're the second or third person we've had in the last 10-15 days who's saying that exercise caution. Ashwini Agarwal, I remember, was the first person who told us that, this is the time perhaps to just take a step back and take a little bit of profits, a little bit of caution in the system. So keep an eye out on that. The early take on the market looks like it's going to be flat with a bit of a negative bias. Remember yesterday as well, the dips were bought in late trades. So, that's something that has been the case for a while. But here's the first take on the index. The Nifty down about 20 odd points. The Sensex down 150 points. So it's a slow grind to the bottom for now at least. Not too bad, but yes, slowly grinding lower. 50 points lower, now 60 points lower. Now almost 70 points lower for the Nifty. The Bank Nifty is the one that's dragging its feet, about 200 points low on the Bank Nifty. And the Sensex is now down 250 points. So all four indices in the red, Sensex, Nifty, Midcap and the Bank Nifty. It's not alarming, but it's a cut of around 0.3%. What's dragging today's technology stocks? Wipro, Infosys, HCL Tech are all in the red. Tata Steel, some of the metal names also trending in the red right now. TCS, remember both TCS and Infosys come out with numbers on January the 11th. So in the run-up to that, there's a slight bit of caution. Banks are also under pressure. IndusInd, Kotak Mahindra Bank, ICICI Bank all down about 0.5% or so. So it's a dual combination. It's a combination of both the technology as well as banking names that's dragging the market a bit. What's holding afloat? Adani Group stocks ahead of that final Supreme Court verdict. Adani Group stocks up in the green. Enterprises Ports up about 3 to 5%. M&M is up 0.7% on that Motilal Oswal report. And then you have pharma names. Divi, Cipla, Sun Pharma are all in the green. Reliance is also batting for the bulls this morning. So let's see how far that can go. But for now, the Nifty just hanging on to 21,600 by the skin of its teeth, down about 50 odd points. Not a great opening. Let's see how this goes.
Well, that's right, Sonia. Well, plenty of stocks moving around actually from the broader markets. MOIL came out with their operational update for December as well as year to date. And it looks quite good because, they've grown by close to around 40% in dispatches as well as in terms of production. So the street likes that. The stock is up close to around 3.5%. On the flip side, a couple of stocks that did very well in the last few days, they're pulling back a little bit. Case in point being a Nalco. That's down close to around 3% yesterday, ended at the high point of the day. Vodafone Idea posted clarification coming out from the management that, denying any sort of rumors that any big party is looking at buying a big stake in the company. So that stock is down close to around 3%, but actually it's pulled back all of those losses as we speak. Nalco, though, continues to struggle. You have Tata Steel that's down close to around 1.5%. Kotak has gone ahead and downgraded the stock. They say that 20% rally that we've seen in the last 2 months, well, that's not warranted for. A few more stocks that are in focus today. You have, Sham Metallics. Stock is down close to around 1%. They're going to be doing a QIP, so that's one of the reasons out there. VST Industries flying away. Mr. Damani acquired more than 2 lakh shares via the block deal, so the street likes that. CSB Bank, I think the street wasn't too impressed with regard to the operational update that they put up. I think CASA has come down, so the stock opened up with a cut of around 1.5%. For the time being, it's just holding with a cut of around 0.5%. Sirvi?
Okay, so for the timing, we're holding 21,600 on mid-caps. Of course, the Adani Group, as Nigel mentioned, that's the one that's really, surging away. RVNL won a small order to upgrade one of the stations, 2% up on that stock as well. On Motherson Wiring, there's a lot of chatter on Samvardhana Motherson, actually, that we might have Sumitomo selling a part or all of its stake. There's chatter, there's a money control report out there. And of course, we're also awaiting a response from the company. So just putting that out on the table as well. That's a stock down to 2.5% at least as of now. Lemon Tree, last I saw, was actually seeing more follow through, another 2-3% up after yesterday's massive surge on Lemon Tree. So that's a stock in focus on the upside as well. But overall, the market's quiet, digesting, of course, the big run that we had towards the end of last year. Venugopal Gare, Managing Director at Bernstein, is with us. Venugopal, thank you very much for joining in. Season's greetings to you and wish you a very, very happy new year. Now, you are calling for a bit of sobriety, right? I think you're looking at 8% return this year, and you're saying, you're telling clients book profits. Tell us why. Why the caution? Is it simply because of the run-up that we've seen, a very strong run-up in the last 2 months? Or do you see any other risks or red flags out there?
Yeah, so I think this book profit call is clearly not consensus. The fact that even after releasing this report on Jan 1st, I've had conversations with quite a few investors. I don't think investors at this juncture are too worried about both the macro and the earnings landscape. But the reality is that the fact that everybody across the board is struggling to figure out how to eke out decent size returns on India at this juncture. Now, interestingly, this is not just a challenge that portfolio managers are finding. This is a challenge which even analysts would find both across sell and buy side, and in terms of a struggle to see how to increase their target prices. So believe me, you'll see a lot of creativity out this year in terms of trying to figure out how to generate more returns. But the reality is that valuation ceiling is fairly intense. Now, if you were to think about it, earnings growth this year is fairly decent. Broadly a mid-teens clip for the headline indices and probably higher for SMIDs. But the reality is that, are we going to see earnings upgrade this year, especially in a year where macro is decent but not necessarily going to see an incremental positive momentum compared to what we saw last year, because last year was on a low base, right? So we swiftly moved up and quite rapidly moved up. So earnings upgrade cycle doesn't look like the case at this juncture. Decent earnings though. The second thing is primarily that if I were to look at it, a lot of the positives, especially around the rate cuts, which are expected this year, both from a US perspective as well as potentially from India. We're also seeing a situation where broadly there is a political certainty expected, and especially after the news flow post the state election results. That's also something which is priced in. So these are the positives, which essentially in our view are priced in. See, purely very quickly from a risk standpoint, the reality is that risks don't really announce themselves. They keep looming around somewhere. You just need to figure out whether those risks basically translate into a reality. For me, the simple things primarily are that a premature interest rate cut, in my view, would be a mistake. And that's primarily because it's going to revive inflation fairly quickly. And this I'm talking about global perspective. India's rate cycle cannot create any inflation. It's basically about what happens in the world. So that is something I would worry about. Number two, El Nino is still a risk from a point of view of monsoons and what it does to rural sort of economy. Number three, primarily would be the fact that US, there is still a lack of clarity on where they head in terms of economy. Now, if there is a rude shock or a sort of a really big shock out there, that's sort of something which is not priced in. More importantly, there are wars going on. We don't know what happens to that, but these are like the outer cases. So there are some of these sort of macro global risks which are looming around, which we need to acknowledge.
Okay, hi Venu, good morning and good to see you. When we take your caution on board, but let's talk about a couple of sectors that did very, very well in the last 12 to 18 months. The power sector, that's done very well. The question is, you all got it right on the upside. Stocks like NTPC and all have done well. What do you do from here? Will you take some money off the table, or do you believe India's economic growth is going to be there? Power consumption is going to be the need of the hour. And that's why you continue to hold on to these stocks, because valuation-wise, some of them are still not very, very expensive.
Yeah, so in this entire construct of India call, remember that everybody is running a fund where they need to have positions, right? So it's all a question of how do you actually outperform a Nifty, which may not generate much returns. Number two is return expectations should be lower across the board, even if you pick stocks. But this is the year of bottom-up stock picking. Now, in that construct, since you mentioned about utilities and stocks particularly, now the reality is, yes, this is an election year. Power, you need to, of course, ensure there are not too much of cuts, right? Especially in heading into elections. And more importantly, there's a shortage going on. So these are fundamental underlying drivers which are going to lead to ordering, right? Doesn't lead to earnings growth suddenly for especially those which are regulated utilities, don't have a merchant exposure. Probably merchant prices might still remain high for a while. So in that construct, you are aware of these potential possibilities which are the earnings drivers. Part of that is, of course, modeled. So the reality is that stocks have also moved up. They've more than doubled, probably gone up even more than that in the last 12 to 18 months, reflecting the reality. We would be selective even in the utility sector, but some of the ones that we still have in the India portfolio are, one of the largest government-owned utility. It still looks okay. I mean, we're just still scraping through some return potential out there. So be selective even there, pick some stocks, but I would still say be careful about governance. Utilities, you need to be careful about governance, especially in some of the stocks where there could be challenges. So stick to some of the safer names which may not give you those sudden, random risks.
Got it. Venugopal, just to understand how to position one's portfolio, right? Is there a higher propensity for a downside in the mid and small cap space compared to the large caps this year? And would you recommend taking positions out of the broader markets first rather than the large caps?
So we actually were big proponents of small and mid caps last year, all through the year. We gave special allocations to SMID, but I have given up right now. So what it means is I'm unable to justify valuations. Two quick things that we look at is implied earnings growth for mid caps over a very longer period. When I say earnings growth is basically typically free cash growth, that's about 18% over the next 15 years. Of course, it's not possible to generate that, which means mid caps, of course, are trading above fair value at this juncture. That's a fundamental issue. Number two is mid caps in general and even small caps relative to Nifty index are trading at their historic peak in terms of valuation sort of numbers. So what it means is that it probably makes sense to take profit in mid caps, and that's the reason why we have turned an underweight on SMIDs. We haven't turned underweight on Nifty, but we have turned underweight on SMID. So that's the area where we're actually wanting to take profits. We want to be still safe and nimble through the year, of course. So that's why we would prefer running with a few large caps. But remember, this is still going to be very bottom up here and there in terms of what we believe there is still potential for earnings to be decent or some upside risks and things like that, and where valuations are relatively okay compared to history.
Okay. Just telling our viewers, if you're wondering, SMID, that's small and mid caps. So that's the new acronym given the absolutely heady rally of 2023 in the SMID space. For the benefit of our viewers, Venugopal, just coming to you, but for our viewers, I just want to point out a lot of the very interesting calls, and many of them are anti-consensus calls that Bernstein has put out. Of course, one is the downgrade of the small and mid cap space itself, but on sectors, they're overweight on financials, which is fine. So is a large section of the market. Bernstein has upgraded IT services to an overweight, and they've downgraded consumer technology to an equal weight. They've upgraded telecom to an overweight, upgraded metals to an equal weight, and they're retaining their overweight in healthcare. And very interestingly, there's a downgrade on real estate and cement to equal weight. And in consumer and industrials and utilities, Venugopal's team is saying stay focused on very selective ideas. Very interesting calls, Venugopal, and I want to start off with IT because financials is fine. I think we've been discussing that with a lot of experts, the expected upcycle in banks and financials. But IT, what makes you optimistic on IT services now, given the patchy record and the very lackluster numbers that we've seen, growth numbers from these companies, and you've downgraded consumer tech. And actually, that is where the numbers over the last couple of quarters have started looking better in terms of profitability and break even. So run us through the thought process here.
Yes, so you're right. This is a non-consensus call, and usually non-consensus calls are very tough to make. So I'll tell you the thinking around this. We wanted safety, number one, which was primarily centered around spaces which were large caps. So remember, consumer tech is usually SMIDish compared to IT, which is large caps in general, especially some of the larger names. With decent balance sheets, free cash flows with potential for buybacks, so you always have that downside protection. Remember, one of the other things that we are not really saying that you're going to be heading into a sudden U-turn for numbers. In fact, as we head into this quarter, we're fully aware that the numbers that are going to come out are not good, right? And I think even guidances might be tweaked and things. But the reality is that we're thinking that we are in a situation for this particular sector where an earnings downgrade cycle to a large extent has played out and will probably bottom, and hence there is very limited interest in this juncture. So this is not an over-owned sector from that perspective, right? And more importantly, valuations have come down from historic averages at this juncture. So there's a huge comfort around this aspect. It would not surprise you. Say, okay, fine, we were expecting this to be bad in any case. So these are like signs of bottoming that we see for this particular sector. Number two, also remember that thinking at this juncture, which has not been, say, we are not building a US stock in our model, right? If we were building a US stock, I would have been technically underweight Nifty and called for a 20% downside, right? I'm not even saying that. So the reality is, if we're going to see these first rate upticks, what is the thinking people have in mind? They would have in mind that, say, US probably will come back on a growth sense. Yes, that will impact inflation later and impact India, but that's like the second order impact. So this sector plays into that, right? And that is the whole idea with which saying that, look, it's not really about near-term momentum. This is basically about this particular paradigm as to why we wanted to take this non-consensus call.
Venugopal, what about this entire financialization, digitization theme? In India, that's really come to the fore, right? And there's been plenty of still be looking to play that theme? If yes, how do you play that? We have discussed this in the past as well. Made India stand out actually, and that was offering big potential. How much has played out?
Yeah. So look, this is consumer tech is a 10-15 year theme. Right? See, but the reality is we have had some successes last year in consumer tech in terms of given to marginal profit, right? So to a large extent, quite a few of the frontline stock, and that is the reason we prefer booking profits. Number two is that the worth of IPOs. And believe me, these will be low, all into picture primarily. We have turned to an equal weight on consumer, not at any calls. This is basically about now, here and now for the near term.
Okay.
Actual perspective ever. So it is all about taking Tata Steel. But the reality is at this juncture, I don't really see a situation. Perhaps it doesn't make sense to go or remain underweight in metals. I'm not even taking a 1 year call on metals, honestly.
This longer term story is definitely intact for India, but maybe in the near term, for joining and giving us that view. Well, let's focus on the next corporate check suggests that the company has seen robust demand from Tier 2 as well. Mr. Thiagarajan, the Managing Director at Blue Star, joins us on the show. Hi, Mr. Thiagarajan. First of all, Happy New Year to you as well as your entire team at Blue Star, and wishing you all the best for 2024. But let's talk about the year and now. Of late, how has demand been shaping up? Do you see enough traction? And are your estimates for the year, what you had set out for FY24, is it in line?
Good morning, Nigel. Happy New Year to you and your colleagues. It has been a great year, 2023, and we look forward to a very, very strong summer season ahead. As you're aware, the results will be out on 30th of January. I won't be able to talk about specific numbers, but the year went on well on the whole. After a washout in the summer season, the demand bounced back. The demand continued to be robust during the festival season. Not only for the room air conditioners, commercial refrigeration products, as well as large air conditioning systems did extremely well during 2023. As we move to 2024, the complete industry is bullish. You might have seen reports. The India is going to be the fastest growing market for air conditioning. And it will be the fastest growing market for commercial refrigeration as well, including cold chain. And in fact, the World Bank report suggests that the market size will be close to 1.4 trillion USD by 2040. And that again brings in the issue of sustainability. And the industry is working on multiple aspects as well. How to grow the market, how to grow it responsibly as well.
All right. Mr. Thiagarajan, we take that on board. I'm just looking through a note that's coming from Nirmal Bang. They say that there's a gap between the industry's capacity addition and penetration into the RAC, that's room air conditioners. For you, what is your capacity utilization levels as of now?
So this had been clarified last year itself that, the market size in India would cross around 10 million units, and Blue Star was expected to cross around 1 million units. You will see the figures as you move forward. And we do have a capacity closer to that as of now. And Sri City Phase 2 is under commissioning. So FY24 will be taken care of. FY25 we will be ready ahead of the time. And as far as the capacity is concerned, thanks to the PLI scheme, the industry capacity in about 3-year time should be doubling from what it was last year. And the market is also expected to grow. I mentioned it is going to be one of the fastest growing markets as well.
Sir, good morning and Happy New Year to you and your entire team. This is Sonia here. Thank you for joining us today. I wanted to talk a little bit about the pricing pressure or the so-called price wars that are underway in your sector. I was reading out of a report which suggested that both Daikin and Lloyd have either been reducing their prices or discounting the channel quite aggressively. How are you coping up with that? Have things gotten worse compared to, say, 6 months ago? And what is the prognosis as far as pricing is concerned?
Good morning, Sonia. Happy New Year to you. This is going to be the case, actually. The manufacturing capacity is doubling. There is a PLI scheme. The market will have to grow. And it has to happen in tandem. In the meanwhile, India is the happening place. And who will be here, and the competition will intensify. We have learned to compete. You have seen our track record over the past 3 years, and we have a modest market share goal. I have stated by FY25, we should be targeting a 15% market share. We are on course with that particular target. You have to compete in the market. You have to improve the margins through innovation, value engineering. And most importantly, this I have pointed out in many forums. The entire PLI scheme, which is close to some 4,500 crores now, that is going to get diluted in terms of pricing. Any PLI scheme improves the manufacturing capacity, and the PLI is paid on the sales growth, right? The nomenclature, production-linked incentive, is misguiding. The PLI is paid on incremental sale over FY21 figures. So therefore, I have to keep showing incremental growth. So are my competitors. In the process, I think that money is going to the consumer's hand, the market will grow, the scale will be built. So there is no doubt that the competition will intensify. Thanks to backward integration, thanks to innovation, you should be able to manage the margin. Most importantly, the operating leverage due to scale. That is what has benefited us throughout 2003. That's what we are hoping.
That's interesting. So you're saying that competition will definitely intensify, but you are holding on to your 15% market share target by FY25. I'm trying to understand what could the extent of the reduction in prices be. I understand that there will be operating leverage benefits because of scale, but how much do you think prices could head lower? And from your end, what is the game plan?
So there are many variables in that. Number one, let me assume that the commodity prices, which is an unknown animal, a number of things happen out there. I would assume that that is going to be stable. That assumption I will make. Exchange rate assumption I will make that will be stable. And energy label change is not going to be there throughout the year. It happened last year. Again, it will happen only year after. Within this parameter, one important thing that is happening is more than 65% of the market is shifting to tier 3, 4, 5 towns. And you have close to 52% of the sale happening through consumer finance. The next one is you are having 92% of the consumers are first-time buyers. So the entry-level products are the ones that are getting sold. So if you ask me to guess, I think the prices are at the lowest level at this point of time. If the summer demand is good, the prices will hold. If summer demand is not picking up, it varies. Somewhere around maximum of 5% reduction can take place. See, each of the element I told you is a huge cost. Consumer finance is a very huge cost that you have to bear.
No, so hi, season's greetings to you. Actually, good that you brought that up. I mean, my first question was actually on margins, just to complete that point. Despite the competitive intensity, as you said, obviously, there's some benefit, I'm supposing, that's coming in from softening raw material prices. So all things put together, the improvement in margins that we had started seeing, I mean, you were at 6% at the end of the second quarter. I'm not asking for a specific figure, but in general, despite competition, can you at least hold margins where they are, if not improve them?
Good morning, Surabhi. This also I have clarified. I used to think till FY21 that getting an EBIT margin of somewhere around 10% is possible. It came down to 9. Today, if you ask me, I think in the next 3-year time frame, anywhere between 8 to 8.5% operating margin is only possible. This is happening precisely due to the factors that you highlighted.
Okay, got that. So that gives us a sense of, the sustainable margin run rate that perhaps companies in the space will have to contend with. Now, just to talk about the other point, you mentioned consumer financing, and 90% of the sales are happening through that channel, and that's where the RBI had tightened screws. Now, it's been a couple of months since this has played out through the system. What do you see on ground? How is pricing shaping up? How are banks and NBFCs looking at a lot of the the consumer loans that they were giving out, where risk weights went up, and therefore, just the cost of giving those loans went up?
Fortunately, we have not seen any major change post the announcement in the past couple of months. And there is also intense competition. The NBFCs are betting on this particular space. And imagine this is a 35,000 rupee kind of financing per unit. And I think they will be in a position to manage without increasing the rates. And I'm only hoping on the competition between them that we should be able to. But then the same point, it's a level playing field. I would be worried that if Blue Star only is at a disadvantage, which is not so.
Okay. All right, sir. Have a great 2024. Thank you for joining in and speaking to CNBC-TV18. So that's Blue Star. The stock has gone up 60% in the last 1 year, but there is definitely competition kicking in now. There's a pricing war, so to speak. And he says that this is only because of growth that is coming through. So everyone wants to get ahead in the market, and this is leading to, operation leverage as well. We'll take a quick break. On the other side of the break, Rakesh Verma, the founder and chairman and managing director at MapMy India, will join in. The board has approved 500 crore fundraising via the QIP route. So we'll speak more about what they plan to utilize the funds for. We will also connect with the management of Senco Gold and Diamonds to discuss demand trends amidst the grand wedding season. What has the response been? More on that coming up.
Welcome back here with us on Corporate Radar, and time now to talk to the next company on our radar. CE Infosystems, or MapMy India, is the next one that we're looking at. The company's board has approved a 500 crore rupee equity fundraise. This is going to be through the QIP route. To talk about this and, of course, plans ahead for the company in 2024, we have with us Rakesh Verma, founder and chairman, as well as managing director of MapMy India. Mr. Verma, thanks very much for joining in. Season's greetings to you. Wish you a very, very happy new year to begin with. Now, if you could just explain to us why the need to raise more equity funds. I think the QIP enabling sort of resolution is 500 crores, if I'm not mistaken. And you already have cash on the books. If you could just tell us what's the latest cash position, why you're raising this money, and what the plans are.
Thank you so much for me being on the air today with CNBC. Well, to answer your question straight, we have approximately 450 to 500 crores in our cash and cash equivalent in our books today. Your second question relates to why we are raising funds. See, MapMy India has always from the past looked forward to a long-term business growth. And you have seen that 20 years back, we could think of getting into mapping business, a digital map, which is paying us a dividend today. We are again looking forward to the next 5-10 years. So when you think like that, you better plan your activities accordingly. So in our case, when we figured out that the future business growth, long term I'm talking about, would be coming from the international market, will be coming from the drone business. These two are the B2B and B2B2C business growth opportunity. And we want to get ready with that, and hence the need for the QIP.
The growth opportunities that you speak of, could they also be inorganic in nature? Because you're building a nice, comfortable war chest of, close to 1,000 crores.
Yeah, you're right. I won't say inorganic. See, when you try to think of the business growth, you look at both organic and inorganic. Like in the case of IoT, what we did go with this inorganic part also to expand our bandwidth in the IoT business. So we don't just make a decision that we'll go only organic or inorganic. It all depends on the opportunity that comes across.
Okay. Just to get some of those, growth targets, just to confirm them, 40% growth is what you were looking at in FY24. I think you're holding on to that, if I'm not wrong. And this 1,000 crore revenue milestone in the next 4 to 5 years, is that on track? And how do you plan to get to that? If you can just share, sort of a long-term strategy with us.
Sure. First, it's on track. I guess our Q3 results for FY24 will be out not too far away. That will give you one level of comfort. The second part is, when you look at the automotive business, one of the drivers for us, for which we build the technology of what we call it case on top of pure vanilla navigation. There's no doubt that the electrification of the vehicles, two-wheeler or four-wheelers, are happening at a very fast pace. That's one of our driver growth for us. The second is when you look at the connected services with the internet in every vehicle, that's adding or giving us the power of growing our business in that sector. Finally, if I say that for safety features in any vehicle, ADAS is becoming popular. So between all the three, the automotive OEM business is poised for a huge growth as the time comes by. So that will help us, part of it will help us achieve our target of that 1,000 crore what we have talked about, built on the technology that we have already done.
Is there scope to, increase your margins further? I mean, you had a very strong performance in the last couple of quarters, clocking in anywhere between 43-44% margins. But you have given a guidance of, I think, 40% by the end of the year. But over the next couple of years, right, just trying to understand a long-term strategy, is there scope to increase margins substantially from these levels?
Look, margins can be easily increased. It all depends on how you want to look at the future of the business. We try to invest that additional margin into creating new products or technology. And that's why we have given a normal 40% kind of a margin guidance.
All right. Hi, Mr. Verma. Nigel on this side, and good to see you in. Just to reconfirm, sir, in the first half of the year, you'll have grown by 27%. For the year, you're guiding for 40%. Means the second half of the year, you have to grow by 50%. Just confirming, that's on track, right?
Very much on track. We are not. H2 is always much better than H1.
Got it. Now, just wanted to confirm that, sir, because the asking rate is 50% for the second half of the year. Let's get that out of the way then. Now, with regard to this utilization of this 1,000 crores, by when will you come up with a detailed plan? Because the street would like to know, right? You've got big ambitions, you're looking at scaling up revenues in the next few years as well. So by when could we get a detailed breakdown? Say, out of this 1,000 crores, how do you intend to use it?
So let us put it in two parts. One is what we have already discussed, the 1,000 crore milestone for a roadmap for the next 4 or 5 years based on our maps and IoT business for the domestic market. What we are talking about, the additional 500 crores, is for the international market and drone as a service business. Now, when you look at them and building up the technology product and creating the market for them, so that's for not the next 5 years, that's for the next 10 years I'm talking about. That is how the overlap is there. So if you're asking about the breakup, I'm giving you the breakup. I gave you the breakup.
Okay. All right. So we'll leave it at that. Thank you so much for joining us. Appreciate your thoughts here on CNBC TV18 and all the best for this year. So that is Map My India with 1,000 crore revenue target over the next 3 to 5 years. And of course, very optimistic on the way forward. But by the way, don't lose sight of the market, which is under some pressure right now. So the Nifty is down almost 100 points. And the sensex is down 350 points, so not looking like a good day so far. And B, the Adani group stocks, which are doing very well ahead of that final Supreme Court verdict of the Adani Hindenburg case.
Sonia, since you brought up the market, I just wanted to put on board as well, just so that we have the context. Actually, we're not alone because a lot of the Asian markets are down a lot right now. You've got the Kospi, for instance, down a full 2%. Hong Kong's down over 1% as well. Even some of the other markets like Australia, etc., falling quite a bit. So declines of 1 to 2% across Asia. I think that's a little comfort that we can take, that at least it's not an India-specific fall. It is a bit of a global risk of playing out.
And why not, right? We've had such a strong run. Some money being taken off the table won't harm anyone. But we are in the thick of the big Indian wedding season. A total of 35 lakh weddings are scheduled in this season. We also had a delayed festival period this time around. So let's find out how demand for jewelry has been. Suvankar Sen, the Chief Executive Officer at Senco Gold and Diamonds, joins us now to talk more about that. Thanks a lot for joining in, Mr. Sen. This is a season that has been the best so far that at least I have seen in the last maybe 5-6 years. But you tell me, how was Q3 in terms of volumes, same-store sales growth, prices? If you can give us both the absolute figures and compare it to the last wedding season.
So see, Q3, if you look at the beginning of Q3 with the festive season and the weddings that are all lined up, we've seen a very handsome growth in the first half of Q3, which is October, November. What we have seen is that post mid-December, when we suddenly saw the gold prices moving up and the wedding season just taking a little bit of a break. Therefore, there we have seen consumers just coming to the stores, exploring, waiting to take a decision. But all in all, if we really look at it, we are looking at about, I have guided before as well that on a year-on-year basis, we've seen a 20 to 25% growth in terms of the overall sales figure. And we are optimistic that coming forward with the Q4 and the wedding season continuing to happen, we will continue to see a handsome growth. The only deterrent that is working in the mind of the consumer is that, yes, at one end, the increase in price of gold is kind of creating some kind of apprehension. But at the same time, people are feeling very elated and happy that the gold that they all possess, the value is going up, and indirectly the faith on the commodity as gold and diamonds is also on the rise. So this is the mixed reaction we are seeing at the consumer end, but we are looking at a 20-25% growth. And the best part is that which will indirectly help on the margins is the growth in diamond jewelry. With the gold price going up, 22 karat gold jewelry prices are on the upper side. So people are looking at 14 karat, 18 karat products, and therefore diamond jewelry for various special occasions be it anniversaries or gifting, that has become a bigger kind of a demand, and we are looking at a higher growth in diamond jewelry segment, which will help consumers be happy as well as the the profit for the company to be on the better side.
Just one clarification. You said you have seen 20 to 25% growth in Q3 so far, right?
Yes.
Okay. But earlier for the full year, you had guided a growth of 18 to 20% for FY24. Would you hold on to that, or would you want to scale that up as well?
No, I would continue to say 18 to 20%. Q3 is usually a much better quarter. And we have seen that, in the first half of the year, things have been on the growth path. But with the gold price on the upward trend, I will continue to say 18 to 20%. But Q3 has been a good quarter in terms of 20 to 25% growth compared to last year.
All right. Okay, got it. Hi, Mr. Sen. Good morning. Nigel on this side. Well, a two-part question with regard to what you just mentioned itself. First, in terms of diamonds as a percentage of your mix, where do you see that number headed with the timeline? Point number one. Point number two is, as you said, gold prices have moved up. So what's your hedging strategy?
So, diamond as a share of the whole jewelry that we sell, it has grown from last year. Today, we are close to 12% as the share of the overall jewelry that we sell. And we are aiming to take it towards 15%. So that has been a thought process with which we have been working. And then our fellow players in the industry have achieved such numbers. So it is not an impossibility. So this is a good thing in the long run. And in terms of the hedging strategy, in spite of the gold prices on the upward trend, we have always been following where minimum 80% of our inventory stays hedged. So whatever we see the margins and the growth, we are getting the margins from the making charges and not really from the increase in gold prices. So we continue to remain minimum 80% hedged for all our inventory, even though the gold prices are on the upward trend.
Mr. Sen, since you're saying that your share of the studded mix will go up, can you give us some idea on how you see overall margins playing out? I'm not asking Q3 or Q4, but in general, if I look at the historic trend, you have been, in around 7.5%, 7.8%. So as the share of diamond jewelry goes up, and I don't know how you're looking at making charges. I'm not sure how competitive, your region is. But is there a way you could perhaps look at margins of 8%, 9%? What's the medium-term plan on margins?
I'll tell you what, a 7 to 8% margin, it is in that range that one continues to play. 0.5% here and there is always a possibility, because with the increase in diamond share, it only gives you that strength in the bottom line. But at the same time, because we are a growing company, one has to continue to remain competitive. With the increase in gold prices, you need to give offers and benefits to the consumers so that they keep getting attracted on buying the jewelry and buying in bulk. So it is a balance that you need to do between your margins and your growth. And that is where, while the possibility of increasing the margins by 0.5% is always there, but you again reinvest. There are new formats, the Everlight, which is the lightweight diamond jewelry and gold jewelry products and collections that we have. We wanted to create a smaller format store with that, invest in branding in various, mediums, digital medium, reaching out to customers. So it's a balance between growth and margin, but it surely will give you a strength in the bottom line.
Okay, and as you had guided earlier, I think margins in the second half will be better than the first half, right?
Yes, it is always like that. With the January, February, Valentine's Day, we call it the love season, the anniversaries. So it's all about love right now.
Anniversary, Valentine's Day, oops, it's going to be quite...
Don't give us ideas.
Yeah, it's going to be it's going to be a little bit difficult on the wallet, but I'll try to manage that. Let's get back to your numbers though, Mr. Sen. What about the store opening? Could you tell us how many have you opened, say in quarter 3? Year to date, how many as well have you opened? And how many of them are, company-owned, franchise-owned? How do you see this number move up?
So we've crossed 150 stores. So as we speak, we are 153 stores right now. In quarter 3, we have opened around 4 to 5 stores in quarter 3. And in the coming quarter, we intend to open 3 stores more. So we have opened approximately 18 to 20 stores in this. We will be opening by the end of the year for the whole financial year. And that is what we've been planning, that on a sustainable basis, we should be able to open 15 to 20 stores year on year, year after year. So that is how we are, planning the whole game for the next 3 to 5 years.
It'll be company owned or franchise owned?
No, it's a mix of company owned and franchisee owned. So around 60 to 70% will be company owned and 30 to 40% will be franchisee owned. So say, for example, 12 to 14 are company owned, company operated, and 6 to 8 will be franchisee.
Okay. I have a couple of quick questions. What's the market share currently that Senco Gold is enjoying?
Market share for our industry, if you look at it, it's like a 7 lakh crore size of the industry. And, last financial year, we did about 4,200 crore. And if you look at the various, players that are playing in the market, so in that sense, it will be in the national level around 1.5%. But then if you break it down to east and north, which share is which part of the country, and then you see that, okay, in Eastern India, maybe we are sharing a market share of 3 to 4. But this is all estimate because there is no, like a proper survey to say the market share for the trade.
Okay, got it. But at least helps us understand, right, how much of the market that you're enjoying, especially in parts like Eastern India, etc. Since you talked about buying gold and, someone like me who has been a consumer of gold, diamonds, etc. over the years, I find it very difficult to buy gold online. But I do understand that players like you are looking to sort of grow your online channel. It's currently about 4-5%, but you're targeting 30-35%. Do you think it's going to be a struggle to get there? I just wanted to understand what is the online strategy now for Senco?
No, so see, online, there are two parts to it. When you look at the lighter jewelry, which is, say, anything between 10,000 to 25,000-30,000, people are getting comfortable to buy online because the risks are lower and it's for gifting or for personal use. So when it comes to the lightweight jewelry, online sales are doing well. When it comes to a little bit of a heavier jewelry, then online becomes a direct-to-consumer platform in which the consumer is having to look at the various designs, look at the prices, compare, take a decision, and then contact these stores. And, it's as we call the digital-led business. And then they take a decision, go to the store and take it physically. So this is how online has to be used as a media to reach out to consumers. So for us, as you said, that it's around 3 to 4%, but 35% is not really a share of the overall sale that you see as online. Is going to take some time. It will remain because the growth will happen, but the digital-led sales is something that will keep growing. The lead generation will happen. People will ask for inquiries and then go to the store and close the deal.
Okay, all right, Mr. Sen, thanks so much for joining in. And as you gave us your growth outlook and you told us the big triggers, anniversaries and Valentine's Day, you put me in a difficult spot, but I'm lucky my wife is hearing this conversation. She said she doesn't want gold for this year. So for me, it's a story of next year at least. Thanks so much for joining in. Wishing you and your company all the best. Looking forward to chatting with you post your numbers.
Very expensive Valentine's Day for many people, right?
Yeah.
Like,
I'm safe this year at least. 2024 is okay. I'm looking at 2025. But anyway, let's get Mitesh back in. Mitesh, we have a market that's been open for the last 45 minutes or so. And we're down close to around 100 points. At lower levels, there was some sense of buying. Yesterday, we bounced from 21,555. And today as well, it seems that level has held out. How do you trade from here?
Well, I think my overall belief still remains that we are going through a deeper pullback, and this decline, what we are seeing since the last couple of days, could extend a bit. So there is a minor pivot around 21,480 mark. So that's a support. But what is important today is the Nifty IT index. That's given a breakdown on charts, and I think that's where you can have some kind of shorting position. So a TCS is something which I would recommend taking a short with a stop at about 3770. It's come down a bit for targets of around 3600. And the other one which I would recommend taking a short is Wipro with a stop at 465 for targets of around 443.
Okay, all right. We'll do one thing. We'll take a short commercial break on that note. On the other side of the break, lots more coming up. Manisha will be joining in to give us an update on the volatility in the commodity markets and lots of stock talk as well. Stay tuned.
Welcome back. Well, let's talk about the commodity markets now. Equities, of course, feeling red this morning. Manisha is here. Manisha, hi, morning. So what's the latest and what do you have your eye on?
Well, I have an eye on gold. I mean, you were discussing all the jewelry market and the kind of events that are lined up for the first quarter. Just let me tell you on how the prices can pan out as well during this time. Well, diamonds clearly can be a better choice because we've seen diamond prices decline by 30% in the previous year. But when it comes to gold, well, we've started this year on a very strong note at around $2,050 an ounce. Remember, last year was the best in 3 years that we saw the kind of gains come in at around 13% on the higher side. We also saw all-time highs in case of gold prices, to be exact, $2,150 in dollar terms. And for the Indian markets, we saw 64,000 rupees per 10 grams. And if you look at the prices right now, we are not too far away from those kind of levels. And expectations are that you could be looking at higher highs, new all-time highs in 2024 as well. Well, if you look at the markets itself, it has been on the stronger side because there are expectations of rate cuts going forward. There is an expectation that you could be looking at around 60 rate cuts happen in the first quarter itself by various global central banks. The geopolitical tensions have been adding premiums to the gold prices also. There also is strong global central bank buying that we've seen. And apart from that, the ETF buying in the previous quarter itself was into billions of dollars, anticipating that you could see a spillover of that happen in this quarter as well. What you will need to watch out for into the markets is the US Fed meeting minutes that are going to be released today. And then on Friday, you have the US non-farm payroll data as well coming in. We already have done a high of 2150, but going forward, there are expectations that you could be looking at levels of 2200 and beyond. JP Morgan is quite bullish at $2,300 per ounce and of an average price expectation for 2024. 2150 is what UBS believes can be an average. 2100 is coming in from TD as well. If you look at Bank of America, Goldman Sachs, well, they are expecting higher levels as well at around $2,200 per ounce on the higher side. Less bullish is what you have seen come in from Metal Focus at 950 of an expectation. And the least bullish is Fitch, which expects that 1800 also is a possibility for this year itself.
Okay, all right. Thanks a lot for that, Manisha. Well, let's talk about Tata Steel. That stock is under pressure today. Kotak has gone ahead and downgraded the stock to reduce from buy. They say, yes, the stock is up close to 20% in the last 2 months, but fundamentals actually have deteriorated at the margin. And they've given 5 big points that have pulled out. One is that the domestic margins were under pressure because the raw material prices have moved higher at a faster clip in comparison to steel prices. So that's point number one. The second factor is Europe continues to remain under pressure, both on demand as well as on pricing and margin contraction as well. So Europe will continue to bleed. Now, all eyes are on the expansion here in India. And the India business actually looks very, very good. But the KPO2 expansion, that's the one that will drive growth. But that could possibly be risk in terms of delays, which is a bit of a problem point. The other point that they've highlighted is capital allocation risk with, that's increasing because Europe could be in a sticky spot and that's why additional cash could have to move out there to support those operations. That's what in turn could make capital allocation a little bit challenging. And finally, they say, yes, the UK operations, they managed to strike that deal with the government, but there could be a possible delay in that UK resolution. So put all this together, Kotak has gone ahead and downgraded the stock and they've listed these broad points with regard to why they're a little bit skittish on the stock post that 20% up move that we've seen in the last 2 months.
Okay, that's Tata Steel in focus today. By the way, just want to point out that today's intraday low so far is exactly the same as the low that we made yesterday, which is the level of 21,550. Today it's 556. Yesterday it was 555. So market's taken support over there and is trying to see if some buyers come in or not. But it's proving to be a little tough so far, given the fact that IT continues to struggle quite a bit. Large cap IT, Infosys, Tech Mahindra, TCS, Wipro. It's a complete slam dunk on IT. And banks in any case are not providing much comfort or much support. Mid caps, I mean, this was very similar to the trade that played out yesterday. Relatively speaking, mid caps have bounced back. But IT is a problem child. Yeah. Just to talk about the Adani Group as well, all of those stocks are actually retaining gain and actually building on some of that gain as well. So Adani Enterprises, Ports, Adani Green, all of those stocks are up and about. So gains between 3% to 6-7%.
Just 1 point, Surabhi. Yesterday the low was 21,555. Today the low is 21,556.
That's what. Yeah.
And from there we have bounced close to 35-40 points out. So let's see whether or not that can hold out for today, 21,515. Let's see whether we can bounce on there.
Absolutely. Okay. So I guess on that note, we will take a very quick break. Come back on the other side, and we'll have Lata joining in with today's edition of It's the Economy. The Indian economy has clearly been the gold medalist of 2023 with a likely 6.5% GDP growth, fastest among large economies. Of course, even as a large US economy grew by 5% in the third quarter. US and global economy is clearly expected to slow in 2024. So what really lies ahead? All of these trends will be discussed when we come back.